Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Paul, thank you for taking some time to join me on the program.
Pleasure.
This is like a really important moment for me because to speak with you and seeing all the things that you've done over time is, this is a big deal. And I'm so glad that we were able to get this time together. So thank you for venturing into town and coming and meet with me.
That's kind of you. Thank you.
Today we're going to talk about a lot of things, but I know obviously vast knowledge in terms of investing, finance, these types of things. But the way I'd like to start is to talk about yachts and sailing and being on the water. I am not a sailor, but I have a boat and I spend many a weekend on the boat fishing and going around and seeing all types of places down in Wilson's Prom in Victoria and these types of places. A bit colder than the waters up here. But I know that you're a keen sailor, and to the extent that you even owned a boat that won the Sydney to Hobart race, which is, for those of us that aren't as familiar, which is the biggest deal. So I'm curious, if we take about that part of your life, are there any lessons that you've applied to either investing or the way you think about business from your personal life?
Look, first thing is, this is clearly dreadful financial advice, as you know. Don't go anywhere near a boat, let alone a high-performance Transpac 52 with myself and my 13 crew. So, and also, look, frankly, taking a 52-foot, basically, piece of carbon, which weighs next to nothing, into Bass Strait is just, look, it's simply not the smartest thing on the planet. So what have I learned? Well, number one, the thing I've always said about boats is that you make sure you're financially secure, and then and only then does a boat come into the budget. I mean, these are the ultimate depreciating assets. Not only they depreciate like crazy, particularly a racing boat with carbon sails and so on.
I can imagine.
It is, well, someone said, is it tearing up $100 notes in the shower? No, it's actually tearing up bank bills in the shower. So you really only do it when you're so it's later in life generally. You put a little bit of money aside before you start wasting it. I've been racing boats since I was 7 or 8, out in Griffith and Lake Wang, and the only analogy I can come up with is really it is about planning and sticking the course. And when it comes to money, look, I'm a time in the market person. I'm not a punter. I'm not a speculator. I don't think I'm a genius. I'm a real time in market. And where sailing and my investing, may not be someone else's investing, match is basically planning. We have fabulous computerized weather models as we're racing to Hobart, Bass Strait, and what do we go to face, and wind directions and wind angles, and do we go out near New Zealand? Do we tuck in under where you go fishing, under Wilson's Prom? All depends on wind angles. And so in a sense, if you like, take the economy, all of these variables are there. You can't guarantee the economy as you can't guarantee the wind. But all I know is you're better off with having a plan for your money and adapting than having no plan. And it's the same for sailing. You're miles better off having a plan. And then in day 2, the wind forecast you got, the satellite models go, oops, everything's happening 12 hours later. You change your plan. But at least we set off with a plan. And I think also in terms of running a business, for me, I think I went Hobart as 60, I would have been 60 odd years old. I'm 69 now. And so I went in 2015 and done quite a number of Hobarts. So for me, the planning, I really enjoy having the 13 crew. It's like being part of a footy team, really, isn't it? 14 of us. People's motivation, ensuring, in particular with investment, the boom-bust cycle. It's also ensuring that if you do get a whopping great gale in Bass Strait and you do have 30 and 40-foot seas breaking over your boat, there's also a sense of staying the course. One of the worst things you can do in sailing is panic, turn around and run with the storm. Then the storm follows you. You're better off ploughing into the damn thing. Market downturns and so on. If you've got a strategy, it's a sensible strategy. The comparison is you're better off, got a good plan, storm turns up in investment. Generally, you're better off sailing into the darn thing, stay the course and come out the other side.
Well, I love that. I think you started off by saying there maybe isn't that many, but wow, those work really, really well. We've actually had some professional sailors on the show before, and it's wonderful, and Olympians as well. And hearing the anecdotes and the kind of multidisciplinary approach that comes from sports or teams or whatever the case may be in another life, it's so fascinating to see how they kind of mirror across to investing. Let's switch gears. Mitchell Snedden wanted me to ask a question. He, and it's a great question. I like it. He said, ask Paul, what was the most recent share or active investment that you've made? So, you might be dollar cost averaging or something like that. But if you can think of something else that maybe you had a conscious choice and you've actually made a decision and you pulled the trigger, what would that be?
Let's step back. First of all, you've got to think about your own money personality. I'm certainly plenty smart enough to know that I don't have the time, the training, or the diligence, to be blunt with you, particularly around smaller companies. And I know I need to be in them. Logically, my asset allocation says I'm like Albert Einstein. Some small companies are going to fail. Where do big companies come from? They generally come from small companies. So I need to be in that sector. So for me, a couple I've made lately is that I look for people who, obviously they all know far more than I do about small companies. But for me, and again, I need to disclose my bias, I'm chairman of InvestSMART, and so I know Nathan Bell there very well. Look, honestly, it's like me in the 50-foot high-powered race boat going across Bass Strait, and you might be doing some lovely fishing in a quiet bay somewhere. That's the analogy between Nathan and myself. He is a high-performance, literally 24-hour a day. I think he dreams investment. And so it seems to me that what I do if I was backing anything, be it looking for a new crew member for the boat or whatever, it seems to me you want experience, knowledge, dedication, ethics, and so on. And so, I've recently, a little while ago, I put some money into one of the InvestSMART high growth funds. And people go, oh, but you are a money expert. I'm not a money expert. It's unfair. I am a money expert, but I'm a GP. I know little bits about a lot of stuff. Why on earth would I think I could choose smaller companies, which probably need to be 5% of my portfolio, logically, just technically logically? Why on earth would I even have a crack at it? Honestly, it's like I wouldn't catch any fish on your fishing boat and, shove you on my TP52 in a storm in Bass Strait, and it may not be your favourite thing either.
I wouldn't say that.
So for me, it's looking to, and it's not even picking winners, it's just saying what gives me the best chance of succeeding in investment in an area I cannot do. I'll lose my money. I can't do this stuff. Now, look at some of the companies that Nathan Bell buys. Never even heard of them. And yet I know that he and the team, there are many small company people out there, by the way. I'm not saying he's the one and only, but it is an advantage for me in that I've been a chairman for nearly 8 years now. And it's like looking at a crew member on your boat. You go, gee, this guy or girl, they're pretty good. They've seen storms and gales and, they've seen bad stuff. And I kind of seen that with Nathan. So for me, it was a pretty easy choice. But another one I've had some money with for a long time are a small unlisted crowd called Monash. And again, I like Monash. I'm nothing to do with Monash, by the way. I used to chair one of their listed funds some years ago, but they folded into an unlisted. And Simon and Shane, the two fund managers there, very much like Nathan Bell. I just think they're honest, ethical, know what they're doing. And I think they give me the best chance of doing well in smaller companies. But let me tell you, if you're never going to see Paul Clitheroe offering a smaller companies fund, there would just be a fraud. The amount of experience and skills you need to do that. So if I'm going to go active, I don't particularly care which companies they buy. I've just got to go for the best ethical people, pass my money on to them, and leave them to it.
I like that. And in terms of if we zoom out and think of like the broader financial picture of Paul Clitheroe, we think, do you seek out that kind of best of breed in every aspect? So you start with that plan that we're going Sydney to Hobart. This is your plan, and you've got, say, Nathan and the team at Intelligent Investor for crossing Bass Strait. You've got another team for something else. Is that how you think about the way you build your financial picture? Is finding the best of breed in each slither of what?
I think a real thing for me is that for me, I admire people who love to manage their own money and might spend 4 or 5 hours a day on it. It would bore me witless. I'd rather go sailing. I'd rather play golf. I want my money to work for me. And so, to be quite honest with you, I suspect I might even end up getting better performance than people who are spending 4 hours a day, because I choose people who do 12 hours a day work and 12 hours a day dreaming about investment. But yes, look, best of breeds I don't want to overdo the sailing analogy, but the TP52 I bought, it's called Balance, all my boats have been called that, but it had previously won Hobart as Quest. And so you kind of go, it's a bit like the Nathan Bell story, isn't it? You kind of go, okay, the darn thing has won Hobart once, and against 140 boats, so it can't be a bad boat, and it didn't sink. That cheers my wife up no end. So that's got to be good. And so so this idea of it's not backing winners. That's silly. This share's going to win. This share's going to lose. But I in my personality, I do have this thing that just seems to say, look, and it's the reason I don't trade much. I've got this thing that says, if it makes economic sense, it's been good. For me, one of the most likely predictions of the future is if it's been good, it will be good. I'm a real spots and stripes person. If a person is good and ethical and smart, I believe they will be keep on being good and ethical and smart. In other words, I don't like seeing tigers who become leopards. That makes me very, very, and we see that investment. We see many changing spots and stripes. And so, and also the thing is, this sort of nonsense about, earning 50% per annum or, we'd all be billionaires, for heaven's sake, drives me absolutely nutto. And so, so for me, best of breed is really important. And also I'm always looking to minimize tax and costs. And so for me, for choosing either a good sailing boat and try to sail it as well as myself and my crew can, or choosing a good investment that I know nothing about, like smaller companies, and choosing the best captain and crew I can. Look, it doesn't seem very hard to me. Like I'm not going to go wandering around the markets picking up companies I've never heard of. It's just nonsensical.
Why are your boats called Balance?
That's a bit of we had 3 kids and starting my business IPAC, it's the age-old story, and I know there's you want to ask about this. I might as well do it very, very quickly now. I've always felt that how do you interfere with risk and return in investment? And generally you can't. Term deposits, low return, low risk. At the other end, if I'm chasing higher returns, high risk. If someone's offering me 100%, I know they're a crook. Pretty simple, really. So that's my risk framework. So how do you alter risk? Well, in our world, obviously gearing is one way of altering. The gearing does not change the underlying investment. It's either a multiplier on the way down and you get smashed, or it can enhance on the way up. So I'm a real believer in risk. And so I thought to myself, when I finished my uni and did some time as an investment analyst, and then thought, well, how do you alter the risk framework without losing your shirt? And it seemed to me, looking through, and I'm nowhere near any rich list, believe me, but looking at our rich list, they seem to be a lot of business people. They seem to be men and women who started a business. And I thought, And so it seemed to me I was enjoying investment. I could see a gap in the market with 3 of my mates that I'd known for a while from uni days and work days. A gap. It was that in those days, it was all about flogging investment for the highest commission possible. 8% entry fees, you know the story, 4% ongoing fees, the poor old customer. And we just thought, with this commission thing, how can you ever sit on the side, the client side of the desk? So we started up IPAC as fee for service. And to do that, this is answering your question directly now. To do that, we had very little money. Vicky and myself had $15,000, which put aside. My dad very kindly, I said, can I borrow $5,000? And Dad said, no, you can't, son, but I'll gift it to you. Because it was $20,000 to get us going. And with that, we rented a serviced office and got a license and, started getting out and talking to all the people we went through uni with who were lawyers and very junior lawyers, bankers. And, we gradually built this business, which people said that won't work. Who would pay for advice? And back then, we'd say, well, of course they won't pay for the advice they're getting. It's crap. I wouldn't pay for crap either. It's commission selling crap. And that was my big bias, was that I don't mind if someone earns a commission on a pair of socks or a pair of undies or a shirt. That's absolutely cool. But this is investment. When tax schemes are paying 40% commission and probably the right advice back then when mortgage rates were so high as to pay off your mortgage, well, how's an advisor going to tell you that and still eat? So it just seemed to us that fee for service made sense. People said, that won't work. And of course, nearly, I exaggerated, nearly 40 years later, I'm 69. So nearly 40, I started the business at 26, 27. So 40 odd years later, of course, that is after the Royal Commissions, and that is now the only way you go. But what happens in starting a business, and people go, oh, look, you sold the business for AXA. Europe bought it, eventually got too big for the group of us. And people say, oh, you got lucky there. And I went, a bit like winning Hobart, you do need a bit of luck, but you also need a strategy and a plan. And no one wants to mention the fact that typically starting your own business, you don't get paid for the first 3 years. You risk all of your money. And in my case, Vicky worked for a couple of years longer than she really wanted to. We like to start a family. But Vicky deferred all that for a couple of years to work as a school teacher, or we didn't eat. And so, but that's a risk we could manage. We were young. It didn't work. We were down $20,000, but at least I'd go and get a job somewhere else. And so it's also risk at the right time of your life. I'm not risking 20,000 plus 15 plus my dad's 5,000 was the only money we had. So we risked 100% to give it a shot. Now, obviously at 69 years old, I'm not risking everything I have to give another business a shot. So it's also, risk is very age dependent. And one of the tricks is that I think when it comes to business, if you can, it's much safer to take risks earlier in life or midlife, because at least you can go on to another job. We're pretty lucky with jobs in Australia. And so that for me is kind of, it makes any sense at all to listeners, that kind of is my sort of risk framework. How can you shift risk? Well, one way of shifting risk is to go into a business providing, back to my sailing here, providing you've got a great business plan, providing you think you're not sailing into a hurricane, and providing, in my case, my partners at IPAC, my 4 partners, we're still mates 40 years later, and finding 4 ethical, intelligent, hardworking, good people.
The fact that you keep coming back to that, the ethical part is really important. I think the character of a person is so important. But in finance, it's often seen as like this soft, kind of fluffy idea that it's not, we can't put it in a spreadsheet. We can't take that to the bank. And so often that's what we do as business owners, as investors, is we back people. I did have a question actually about the business itself. And this is more like a tongue-in-cheek question, because it might have some interesting takeaways for you, is when your dad made that gift. Yeah. But I would think of that almost as, instead of a gift, I would more call it an investment in you.
Correct.
And I feel like that might be, if we look at you today, that might be one of the greatest investments that he ever made. I don't know his situation, but for him to do that, to then support you to go on to do what you did, is a wonderful thing. And I wonder if you do reflect on that, how you think about supporting, say, your children or other people in business.
Yeah, look, it's a really interesting question. Obviously, in a sense, my dad and mum, my dad was a specialist doctor in England, and we came out to Australia as 10 quid poms when I was 8. My sister was 4, went to Griffith, New South Wales. The reason we're there is that, I kid you not, Griffith had 14 doctors. I think they were all English doctors. And so a guy that Dad knew from Manchester, where he did his med studying, was the local surgeon, and said to my dad, I think he knew my dad would have a bit of he wasn't really enjoying the British winters and so on. And so John Binks, the surgeon in Griffith, would ring my dad every month or so and just say, you really need to come to Australia, John. You really need to come to Australia. So off we went. But as a doctor, money didn't really interest him at all. But what did interest him was he just said, son, only do medicine if it's a passion. And I said, well, yeah, but it's kind of been in the family for a while. And he said, well, yeah. He said, but look, my only advice to you is that if it's a passion, do medicine. And my dad never needed to worry about it. He worked as a GP till he was 81 and then died when he was 81, which was his dream. He didn't want to die. But he got a cancer, and these things happen. But he always hated the idea of not being a doctor. And so that's passion, right? Yeah. And I could see my dad going out, because as a country doctor, you deliver babies, and I could see Dad, your phone would ring at 3 a.m. And I was thinking, this looks a bit like hard work to me. And so Dad said, well, if medicine doesn't seem to be a passion, do something where the government doesn't pay you. Oh, what do you mean do something where the government doesn't pay you? And he said, you're probably better off running a business where, in a sense, you control your billing and your income. And he said, so the private sector is probably the way to go. And so that's, I think, one of the reasons when he looked at my business plan for IPAC with not mine, actually, Run Abe, one of my partners, drew up the business plan. Great business plan back then. And my dad said, Dad actually did want to understand it. And he said, oh, no, I won't lend it to you. I'll gift it to you. So that is a really important thing. But in terms of other people, where my mum and dad were great liberal English people, is that money was discussed at the dinner table. And that's probably more than the $5,000. That's probably the most valuable thing that myself and my sister got, that they'd put £100 a year into shares for us, which as young people we didn't understand. And guess where my $15,000 came from?
Ah, right.
Yes, £100 a year turned into $15,000. In fact, it turned into a bit more. Vicky and myself were able to start IPAC in the early 1980s. And we also had an extra $10,000 that we could put as a deposit on a minute semi in a busy street and took a mortgage out for the rest. So my mum and dad putting the equivalent of about £100 aside in just classic shares. I think they bought Coles, Myer and BHP and just stuff, £100 or so, not a fortune, £100 or so a year for 25 years or whatever it is. And all of a sudden I had, plus my dad's gift, I had the capital to take up my $20,000 stake in IPAC. And we had this little $10,000 left over, which we, based on my wife's teaching salary, the bank wasn't going to lend me any money, but based on Vicky's teaching salary, very secure, we were able to buy I think we bought a tiny semi-detached house for $90,000, I think it was.
Wow.
So isn't that an important lesson?
Yeah, it is.
So in a sense, it wasn't just the $5,000. It was talking about money at the dinner table because, sex and money have probably always been taboos at the family dinner table. And I think money's kind of an easier one to crack. But right here and now, I still think there are a lot of people who are saying, how do I help my kids be better with money? Don't bore them, but at appropriate times at the dinner table, talk about it. Don't hide it. Talk about it, even if it's not good money, like got a problem with a credit card debt. You don't want to frighten children at inappropriate ages, but talking to kids about the ups and downs of money. So I do remember in our family, this is not a 90-minute conversation over dinner. It's just dad might or mum might say something about buying something or whatever. Or, mum and dad might say, look, this year, is it a new car or a holiday? And myself and my sister would go, new car, holiday. And it was the mum and dad's decision. But it was interesting that we got these really fundamental ideas about you can only spend what you're earning. It's all you can do. So for me, just a fundamental lesson for parents, and it really impacted my life. It's why I have a career in money. It's why I've done okay with money, because in a sense, without that little bit of money that had been put aside to me, I could have joined IPAC as an employee. But in shifting that risk return model we're talking about, I think personal endeavour, probably giving up income, probably working 18 hours a day in your own business, it's probably a way that you can use your skills to shift the risk paradigm without losing your shirt.
Mm. Yeah, it's like the leverage that you get from your
personal initiative.
Yeah, before I get to my next question, I do want to just quickly double back to this. Yeah, the name of the boat's Balance.
Oh, sorry, I missed it completely.
No, I'm just curious. I know it will just sting me if I don't.
Okay, sorry, that's my fault. I rambled on in a different direction. The idea was that Vicky was very keen for me not to start doing Sydney Hobarts until the kids were old enough to live without a father, which is fair and reasonable. Well, we've had 6 die in the 98 race, tragically, and so on. I'm still a bit short of a finger, which I tore off out at sea. Sorry, that's an exaggeration, only part of the finger. But it is a fairly silly, particularly in high performance yachts. And so when I started doing Hobarts, I turned 50, and Vicky very kindly said, it's time for you to go. And so I started doing Hobarts then. And the idea of that was in someone else's boat. But when I was able to afford to have the spare money to lose money in a boat, Balance was a reminder to me about life, and that there's nothing clever about it. It's just, I love sailing and work hard, love the family, love my kids, love the grandkids. And so it's an overly used word, but it works well in sailing because it also means trying to stay upright. Though, mind you, there are quite a number of helicopter shots around where we have tipped the boat into a giant wave, and there's some some not funny at the time, but as you can imagine, the media loved Paul Clitheroe's Balance looking highly unbalanced with a photo of us lying on our sides out at sea somewhere. Because when you're lying on your side with all your sails in the water, boats won't tip completely upside down. We've got dirty, great big keels with a 3-ton lead bulb on them, so they don't flip right upside down. They just crash on their side, basically. But when you're crashed on your side, the name of your boat's down the side of the boat. So you're crashed on your side with waves breaking over the boat. And when you can see the helicopter photos, you can see the dirty, great big balance. So the media thinks it's hysterical. Paul Clitheroe's balance, highly unbalanced.
I like that. So when in the 1980s, when you started the business with your mates, I saw an interview that you did, and at the time, I believe only around 3% of Aussies own shares.
Correct.
And I read in an article, and I'll take this as a quote, you were responding to some questions that were given to you, and you said, if you don't have the history of investing in shares and you have a downturn like 87 or like COVID, they don't have that history of recoveries to lean back on. It's not deep in your DNA. It will be in 100 years, but unfortunately for people, it's not there yet, end quote. So basically, people didn't have that understanding of the share market. They didn't have that kind of the thick skin and the scars maybe to show from some crises. Is there a way you think that people can learn some of those skills? What's the old cliche that the man without a mentor has a fool for a mentor or master or something like this? And learning from other people, like how do people build that resilience and that knowledge? Is there a way?
Look, I think the industry's actually done a pretty good job on education, actually. What you're doing here is part of education. So look, I think you can prepare yourself for the storm ahead. But until you get into the storm, it's kind of hard to know how you're going to react, because where the thousands of years of DNA comes in, we are driven by fear and greed. We are just. And I think we do okay, most of the time. But what really bugs me is that we still see most people are buying shares towards the top of the market. And people to this day, every single downturn, I get all with the government body I chair around financial literacy and so on. So I get to see some really quite interesting numbers. And they are publicly available, by the way, but they're pretty dense. But it's very clear that no matter how as an industry we work on people saying, as you say, the 2009 GFC COVID downturn, that when markets look like falling over 30%, people, they lose. It's not, they don't have 1,000 years. We don't have 1,000 years of downturns built into us. And so we read about it, we think about it. We say, when the downturn comes, I'm not selling. The trouble is that when the next downturn comes, the media and the social media is full of the end of the world is coming. Shares will go to zero or property will go to zero, whatever it may be. And I'm only fearful for us 2 or 3% of the time, but that 2 or 3% is where you really do your shirt. And so it upsets me. I went out, did a nationwide, part of my government stuff, so my pro bono time, did a nationwide tour after both the GFC and the COVID downturn. The GFC in particular was quite interesting. Just saying, look, you own shares in Woolies and BHP and banks and stuff. Most of us just own pretty similar stuff. And do we really think that people aren't going to eat? Do we really think we're going to stop buying a home and borrowing money from bank at time to come? And so trying to because all the questions were, we've only lost 40% of our money. We need to sell now before we lose another 40%. And yeah, sure, you can show graphs of 1929 and you can show a market going down into 1930. You can show a market going down 80%. But, so we have this history of my sailing thing. We have a history of storms. The more you can read about the storms, the better, because absolutely, I'm shooting, if I live to, 69, I think I should technically, if I believe in statistics, I'm pretty healthy, pretty fit. Should have lived to maybe 85-ish, might be more, might be less. But, I'm certain, 16 years, I'm nearly certain to see a 50% plus downturn in that time. And I genuinely am prepared. I eat the dividends from my portfolio. I don't eat the capital. And dividends generally keep coming, as does rent. If my property in Sydney, along with everyone's, in January of 1990, when interest rates hit 18.75%, there is no doubt my property fell between 30 and 40% in value that year. Interestingly, with property, we don't panic and sell. We have property in our DNA. Oh, it'll come back. Why won't your shares come back? Because no one publishes the price of my house every day, thank heavens. And so the other great thing with property, which I love people owning a property, the other thing I love about property is in a decent downturn, you can't sell it anyway. One of the trouble with shares is you can flog them anytime. And so you've really got to somehow learn that the next downturn will come. I don't know when. I don't know why. It will come, and sooner or later we'll get more than a 50% fall in markets. And you need to keep saying to yourself, it will happen. It will happen. And when it comes, sail into the storm.
I like that. When I use IPAC as a bit of like a kind of line in the sand, just so people are appreciative of it. But when most people look at the long-term trajectory of the Australian economy and the Australian share market, or many share markets, they might go back 20 or 30 years. And since then, if we take that view, we've had, rising wages, rising population, globalization, stock market returns, property returns, falling interest rates. And I'm curious, as you think about it, are you still bullish on Australia, let's say? Let's call it that whole thing, that whole complex as Australia. Are you still bullish on Australia, more or less about the same amounts as maybe you were back then?
Look, the thing for me is because I'm a long-term investor and holder, I'm not a trader. On a trader, I've got to watch all sorts of stuff every day. It's just not I just think I'll make any money. I think I'll lose money. But look, where's demand? It's all about demand for property and demand for stuff. I mean, how will Woolies or Coles do badly? Well, if the population drops by 50%, well, then it's not going to be very good for property or Coles. So I'm a huge follower of population. I do use the World Bank numbers, and look at our population globally growing by 93 million people a year. I look at Australia as an attractive destination. Why did we come here as 10 quid Poms? Highly attractive place to be. Look at the life it's given myself, my sister, our family. Mum and Dad have passed away, but our children, my 3 adult children, my sister's 2 adult children, in my case, in Vicky's case, 4 little granddaughters. Australia. Now, so what has changed about Australia to make it any worth? Well, it hasn't, obviously. There's queues of people who'd like to live in this country for really good reason. Then so Australia's population will grow. And we, in a sense, our politicians have the finger on the dial. We can argue, let's not do that argument. We can argue all day, okay? But as an immigrant myself, and growing up in Griffith with a strong Italian population, immigrants, in my opinion, have added huge value to this country. I think the white Australia days with the wall around us were pretty crappy days. My partners in IPAC are called Arun Abe, Piyush Gupta and Savanda Soysa, 2 Sri Lankans and an Indian. Australians, fantastic human beings. And Australia's better off for having them, for heaven's sake, not to mention the food's better. So putting all that aside, globally we're growing at about 93 million people. Yes, I know Japan's starting to shrink because they don't have an immigration policy. I understand aging populations. So the structure is changing slightly towards age. But we're still seeing a growing global population, and we will do for all of our lifetime, our children's lifetime. I can't go past my grandchildren. So if you've got growing population, you're going to get growing demand for food, for cars, for you name it. You're going to get growing demand for property. So basically for me, it's not particularly difficult to say it is about population growth. You tell me Australian population is going to halve, I'm selling everything in Australia. We are economic miracles. I think we often forget that our economy, basically 2/3 of it, is you and I rushing around, paying off a house, buying a cup of coffee. We are everything we do each day. Each of us are little economic miracles. And you add us together and we're 26 million people driving the economy. And yes, outside factors make a big difference. The price of iron ore or, whatever it may be. Absolutely. So I'm just into population. Without population, with zero population on the planet, we can agree we have no economy. I simply take it the other way around and say, well, obviously, so when I'm looking at properties, for example, obviously I would prefer to direct my investment to areas where I think property is going to do better, obviously. And that's why I tend to buy closer in cities where there's less land. Yeah, near transport hubs. Will those properties do badly over 20, 30, 40 years? I don't think so. And they certainly rent nicely. And when it comes to shares, if I am buying shares myself, I am looking at things like, well, I think that health's going to be important. My dear old dad, in terms of good investments, he's a terrible investor. But the one thing he did anaesthetics Tuesday and Thursday in Griffith. And so he understood the importance of blood serum. So he bought $2,000 of CSL on the float. The only punt, inverted commas, he didn't think it was a punt. See, it came out of CSIRO, honest, ethical, scientific people. And he said, look, we're always struggling with blood. This serum, blood serum is going to be enormous. And much to his great joy, the $2,000 worth of the share price has split so many times. I think they're now about $306 or something, but he left $1,000 worth to Jane and $1,000 worth to me, which in turn will pass on to our kids. But I think the $1,000 worth he bought back then is worth, don't exaggerate, no, they're $300 today, close enough to 1.8 million. And now he bought them decades ago, never sold them because he actually saw something. Blood serum. And as a part-time anaesthetist, as he could do in those days, he kind of saw that. So I can't do that specifically, but I can kind of see that, look, tech's going to be important, AI is going to be important, but so's everyday stuff. Food's going to be important. Food security is going to be important. And so I do tend to tilt my investments a little bit, but I don't then go down and try and pick the underlying companies. I leave that to the Nathan Bells of the world. Help me, Nathan, help me.
Yep. We've actually got a snippet because I know in the 1990s you hosted a program called Money, which was wildly popular.
It was.
And it was on the Nine Network. So for everyone watching, we'll put up a bit of a snippet here.
Tens of thousands of people are caught up right around the country, but because it involves a profession built around trust. With interest rates at their lowest levels for decades, many Australians who would normally have their money earning bank interest in fixed-term deposits are looking to get higher returns. And if you were getting 3 or 4% interest, but were promised more than 10% on your money with high security, it would seem a very attractive offer.
The program goes on to talk about basically what I would call an investment scam.
It's a scam.
Yeah, from Queensland. And I showed you just a moment ago what it looks like. Maybe if you wanted to relive that one for listeners or viewers, or maybe some others that you've come across in your time. And I have a follow-up question, which I'll get to.
Okay.
But if you could, off the top of your head even, think about some of the more prominent things that you've come across.
Oh, yeah. Look, I think Sydney side as well, you don't need to be, I doubt if you're 25, but for a long time there were ads going, fly free to Queensland and buy a negatively geared property. And it's all about, tax, paying your property off. By the way, that's all fine. That's it. Most good scams start with the truth. That's why they're so damn dangerous. The ones that are just outrageous, invest in the planet Mars and double your money, we're going to go, well, that's ridiculous. But negative gearing, save tax, fly to Queensland, and they'd put you in a minibus and they'd run you around and show you these townhouses out the back of the boondocks. And the scam was very simple. As I showed on that clip, now this is a long time ago, so let me take a stab at this. I think they were selling the townhouses for around about $130,000, which to a Sydney sider or a Melbourne person, we're going, negative gearing, and they had guaranteed rental returns for 3 years and, all the usual palaver. It all sounds great. But the flaw, of course, is, and I think that's the story where towards the end of it, I'd simply go to a local real estate agent because the tour operator wouldn't let you out of the little minibus. You were picked up at the airport, you were shown properties, and then when they took you to the airport, you discovered they wouldn't put you on the plane home until you signed up to buy something. Yeah, you're not buying anything, find your own way home. It's pretty brutal. So I know this. They were signing contracts in the lounges. They were just, it was just bloody criminal. Anyway, the scam, of course, is very simple. All I did was go to a local real estate agent with my money cameras and focused on identical properties. And I think they were selling for around about $65,000 to $75,000. So the scam was really simple. They were simply selling a property for about twice what it was worth. And it was that simple. But if you didn't, no internet in those days, don't forget. So unless you actually escaped from the bus, which they didn't want you to do, and ran across the road to a real estate agent, but there in the windows is the true price of the asset.
Wow.
Yeah. ripping scam.
It's so simple.
Oh, yeah. Well, funnily enough, that I had some people email me about that a while ago. They must have seen the story online or something. I said, the funny thing is 30 years later, we've actually done okay. But for most people, though, as interest rates rose back in those days, unfortunately, a whole lot of people were forced out of their $130,000 purchase for $65,000 or $70,000. As always with property, if you keep it for 30 or 40 years, it's generally going to be okay. Population's growing. And one of the other big ones back then in terms of trying to understand it. So there's a very clever scam. Couldn't work with the internet. You just go online and Google a townhouse. And again, that's not 130, it's 65. But you couldn't. It's not as silly as it sounds without that research tool called the internet. The other big one, which could still happen today, and again, Queensland and WA come up with these solicitors' mortgages, run by a tiny number of law firms who became huge law firms. They became mortgage companies, basically. And what they were doing is they were saying, look, we'll only lend to 2/3 valuation. What we then did there is we flew up to Queensland and showed that the 2/3 the valuations were dodgy.
Yep.
2/3 of who made up what number. If the property's worth 50 grand, you get a dodgy valuation for 100. You lend 2/3, you go, you're safe, Owen. You $100,000 property, you're only putting 66 into it. In actual fact, it's a 50 grand property. And these mortgages, of course, were offering very high returns to investors. And that's where we come to the more obvious scams. I thought the property one was pretty clever because they weren't promising you artificial rent or they were selling you the property for twice what it was worth. That was quite, you've got to admire some of these crooks. They're pretty damn good. And by the way, you don't go to jail for selling a property for twice what it's worth. Because if someone offers me twice what my house is worth and I accept it, well, I'm allowed to do that. But this of course, was systematic thievery.
Yeah.
So the solicitors' mortgage were offering huge rates of return. And I did also on the Money Show, did a forum on the Gold Coast where I had 1,000 people register to come and 2,000 people we couldn't fit into an RSL club, a leagues club. And they were all basically losing all or most of their money. Why? They knew the return was high, probably twice that of anything else you get anywhere else. And they were going, it's got to be too good to be true. But they were going, it's a solicitor's mortgage. Paul, it's only 2/3 of the valuation. How can I possibly lose? And of course, we were saying, but well, really, 99% of solicitors would say, what do I know about lending money on a mortgage? Nothing. I do the legal documentation. So what do they know about it? Why are the returns nearly double everything else? But the flaw in that one was that, and we can show this conclusively, which we did on the show, is the valuations were not true to market valuations. And that's where the scam in that was. And you need to be really careful with investing in property when it comes to valuations.
Yep. Yeah. Here. We don't mean to necessarily pick on Queensland in this instance. Well, I do hear a lot of those things that happen north of the border. I'm just conscious of time. There's two final questions that I have, and one of them is more just broad strokes. We don't have to get into technical specifics, but over the last year, say 20 years, and InvestSMART is a big proponent of this as well, and I'm very grateful for that. It is the rise of ETFs, exchange-traded funds. And you've been doing this long enough to see some of these things. Like we just come off some pretty blatant things, but the rise of ETFs, do you see that as a net positive, and do you see it continue?
Oh, look, this is fabulous. What's a certainty in investment? Income, be it property or shares, your income or dividends are a relative certainty. Look, capital growth with growing population, I think it's there, not in the short term, they fall in the short term. But the thing that is a certainty is fees. So the fee you pay to get in, the fee you pay to get out, and the fee you pay on an ongoing basis is an absolute known. And so these fees have cruelled investors for decades. And so finally, and I include myself in this, finally we investors can actually invest in high quality underlying assets, be it property or shares, international shares, you choose, it's up to you. If I want a health fund, I can buy a health fund. I want a gold fund, I can buy a gold ETF, you name it. But for the first time really in human history, I can actually access this at zero entry fee. And, some of the big funds like Vanguard, what are we talking about these days? 0.0 mate, 5.05.
Don't even know.
But at 0.05, you don't really even care. So for investors, this is one of the most remarkable breakthroughs. So finally, it was always the case that markets have looked over thousands of years, markets over time have consistently done well. But it's typically the middle person who's removing a slab of that return for us. And in actual fact, this is altering our risk equation, because if we're taking some risk to be a property of shares is risky in the term deposit in the short term. So we are taking some risk to get into these assets. And if a middle person is crueling a third of our return in some form of fee, we're not getting the proper return for the risk we're taking. So finally, we can get honest risk and return. We take market risk and we get nearly all the return. Thank you very much. So we get rid of a known investment detractor, a fee. Oh, look, this is fabulous.
Yeah, I agree. So my final question to you, Paul, and I'll put a link into the video and many of the things that you do. But my final question to you is a bit more reflective, which is if you could go back in time and tell yourself something at any point in your life, whether it's about investing, business, life, finance, whatever, what would it be?
Oh, crikey. Didn't really think about this one at all. It gives me great joy when at Money Magazine, gorgeous younger people email me, ask Paul a question stuff, which I really love answering, by the way. Which it's so fabulous that a 16-year-old might be saving pocket money and an 18-year-old's got a part-time job and a 21-year-old's right to me bought their first property and stuff. And the thing that gives me greatest joy is the fact I didn't do any of that. At university, I worked in a pub to earn money serving beers to buy beers. And, it's a dreadful thing to say because it's all about time in the market. The earlier you start, the higher compound returns. But, you get to my age and a few friends do pass away and a couple in my group die in the last 12 months. Getting started early is fabulous, but your time on the planet is a bit restricted, and it's easier when I've enjoyed 69 years on the planet, okay? And at 69, I really enjoy, I wouldn't in any way I'm nowhere near super wealthy, not even close to it, but I'm financially independent, and I can't afford a Learjet, and I can't afford this, and I can't afford that. The reason I buy second-hand sailing boats is I can't afford new ones. So I've got a whole bunch of budget constraints as well. And maybe if I'd started at 16 by saving my orange picking money and invested it, I would be richer today. But, I think if you need to keep in the back of your mind that money provides choice, and a lot of choices in this country, like going and having a surf at the beach, actually aren't particularly expensive. And it is a bit reflective. I don't want to put people off who getting started earlier is great, but I just think if you dedicate yourself from early times, your friends are going overseas and you think you really shouldn't do that, I think it's an error. I really do. I think all these life experiences. So if your mates are going overseas on holidays or whatever, and you're thinking, I won't have a holiday this year. So look, if you're struggling to pay your mortgage off cost of living, hey, I hear you, pull your head in. But realistically, as you go through life, with those great attitudes from an early age, you are going to be financially independent. And maybe I could have been financially independent 3 or 4 years earlier, but I'm just glad I didn't. I'm really just glad along the way. And probably part of the joy of running your own business, by the way, is we used to laugh about our 40-hour week. We used to work 40 hours Monday to Wednesday and 40 hours Wednesday to Saturday. And so, but it was fun. I was younger. So I do think having a goal, and I don't care what anyone else's definition of financial independence is, that's totally up to you. How much money do you need each year to live the way you want to live? And you may need quite a lot of capital to do that. You may need very little capital to do that. That's your personal goal. And I want you to aim for that goal. But reflectively, I'm really, really, really glad I was a bit ill-disciplined with money until I was probably about 23. Probably bought a few more beers than I should have done. Probably went to a few more parties than I should have done. Probably had a few more trips than I should have done. But you know what? Looking back, you don't need every day of your life to become financially independent. You can knuckle down and get on with it. And I think I honestly believe I feel fresher at 69, bluntly, for having a pretty slack period at uni. Don't look at the marks of my first degree. Just terrible.
Well, you've got many life dividends to pay that are paying you now, as well as financial dividends in the sense of you did live your life. And
I hope to keep living it, Owen. We're not there.
Yeah,
we're not there yet.
We're not there. I shouldn't. We're in
hope.
the present, right? And but all the same, you took that and you took life on, and why not? And I hear that from many people in the quote unquote financial independence community that have those significant regrets, particularly in their 20s and 30s. And it's about finding the balance. And I think you provided a great framework there. So, Paul, this is a wonderful conversation, and I'm so grateful that you've shared this with the Rask community. So thank you for taking the time out of your day.
You're very kind, speaking of an aging dinosaur. But I've got to tell you, these dinosaur years are really pretty good, by the way. I'm loving it.
It looks like you got a big smile on your face, and you're going for a coffee now.
Having a pretty good time.
I really appreciate it, Paul. Thanks again.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.